It's Thursday, February the 23rd. Let me ask you a quick question.
Go ahead.
Do you believe in the January effect regarding markets?
I think it has a relevance that you got to pay attention to. It's a good conversation piece around a water cooler, and it's something to pay attention to, but I believe you put as much weight on current data to either support or offset it, and I think that answer gets me gray enough that it didn't give you an answer.
Yeah, it did. Well, you did not answer the question. No. You didn't even come close to answering the question.
I didn't say yes or no.
You did not.
I did not.
No, you didn't. That was a very gray answer. What we're talking about is that as January goes, so does the market. And with all the headwinds that we see out there, having a good January doesn't necessarily give you an indicator that you're guaranteed to have a good year. But if you look at it just from a statistical standpoint, 6.2% on the S&P 500 was the return in January, which is the ninth best result since 1950. So my takeaway from it is it's optimism that maybe by the end of the year, we're going to see markets begin to gel again.
All right. So I'm going to light the sparkler on current information. Is some news that you brought to the radio show a few minutes ago about the current treasuries. Will you tell our listeners what we're seeing this morning as of the 3-month and 6-month treasury?
So I didn't do the show last week.
No.
And so I went back and I have a running tally of a lot of data from weeks past so I could do comparisons. And so I would have a 2-week comparison on the difference between the 3-month treasury bill at 2 weeks ago versus where it is today, and it's astounding. It's 20 basis points difference. In 2 weeks. And the same holds true, if not even a little bit more, for the 6-month treasury bill. So when you're seeing 25 basis point increases in treasury bills in 2 weeks, it tells you something is amiss.
All right, so go on and give the rates, because I'm going to give the visual.
Okay, so the 3-month is 4.8-ish, right in there, and then the 6-month is 4.15, 5.15.
That's
a 5 spot.
That's a 5 spot.
So it's above a 5 for the first time. It actually hit it last week. So we're still seeing the boring old treasury bills continue to be a good place for us to hide out in.
And what has happened is that the Federal Reserve has come and said now, and there is not a unanimous agreement on this. The unanimous agreement is, though, that they're going to go to June, in all likelihood, in increasing rates. There will be a March rate increase, a May, and then a June. The undecided one is what we said they should have done this month, is they should have done a 50 spot instead of a 25 spot, and there's now enough sentiment to begin to have that discussion. The economy, from their perspective, is still too hot. So what you have happening is you're seeing these short-term rates that are very attractive rates that give us the ability to buy short-term ladders, hold into a strong, safe place, and then still wait for the opportunity. Because we'll ask you the question, and I know the answer because I've had discussions, and you have with our clients. We ask you, would you prefer for us at this point in time to go on and secure a 5% position, a high 4, for 3 months or 6 months, and wait and see what happens, and then to begin to buy in the market? Or do you want to take the chance now to buy into the market?
And most of you are still in the market. You're just in the market at a much less percentage than you were a year, 18 months ago. So it's not, in most cases, most of you are already still in the market. It's just what we're deciding to do with the defensive money, which has been obviously T-bills over the last 12 months. And
so on the 16th, we had a bulk of T-bills matured. On the 23rd next week, we'll have a bunch more to mature. We're going to be in a position 1st of March, in all likelihood, because of the rates they are, to buy 2 more short ladders and still you're in the market, as Gibbs said, but we'll take that available cash that was in treasuries, buy another round of them at a higher rate, and then we'll get into the summertime, and we think maybe summer, certainly by third quarter, we'll begin to make some purchases.
And maybe the January barometer comes in to play for 2023.
All right, so there we are, and that's where we are right now. We're always glad to be with you. Call us if you have any questions or concerns, and we do this because it is your money.
And your money matters.
See you next week.